Hi, folks. Dan Bird here with the daily scan for March 6th, and the market's continuing to free fall towards the bottom of the canyon. There's Wile E. Coyote with no parachute, no Acme parachute. So we're continuing to go down. Doesn't look like there's any hope in sight, but we'll take a look at it and see what's happening. So, as always, I am not a financial advisor. I do this for educational purposes only. I don't make any recommendations to sell or buy anything. And you have to understand your own trading style. So let's see how far down Mr. Coyote is going to go. First, we'll look at the market bias, which went down a little bit more today. And interestingly, a subscriber asked me yesterday, said, we had a bounce, but the market bias still went down, even though the market went up yesterday. Well, that's true because it takes time, especially when there's a lot of selling like we've had. Then the moving averages get pretty far away from each other. So it takes a while for it to switch and go back the other way, and it's certainly not one day. So it will take multiple days of a rally before it starts to move higher. You can notice, though, that the lines between the dots is getting shorter and shorter, which means there are fewer bear signals, even though there are more bear than bull signals. There are fewer each day. That's what makes that line shorter. So let's take a look at that. The other thing for subscribers, if you go to the market bias page, and in addition to this little chart that's on the home page, you can see the week over week trend for short-term, medium-term, and long-term. And you can see the short-term has actually ticked up a little bit, even though the medium-term is continuing to fall lower. And interestingly, the long-term actually ticked up as well. But that's usually what happens because these things are all delayed. So we actually might get a few of these long-term bears switch over to bull right at the end of this downtrend. And you can see there are more medium terms now flipping over to bear. We've got now our three major indexes now are all bears in the medium term. So that's the way it usually goes. It goes from left column to middle to right column. And there's some momentum behind these as well. So it can take some time for them to move. All right, well, let's take a look at some of the key ones, as we always do. We'll look at S&P first. And the S&P today continued to go down. We are now below that highlighted channel. As I talked about yesterday, it's not a specific absolute number. It's not exactly 58.50. It's somewhere around here is where the support is. And we went through it today. And it actually went down below this downtrending channel line as well. So that's extremely oversold, but that doesn't mean we can't sell more. You can see the 3x ATRs down here, and we're not there yet. So we could easily continue to keep going down. One more day. Tomorrow is the jobs number. We're going to look at that in a minute, and that may move the market one way or the other. If we have a bad one, then the Fed may cut. And next week, I think inflation, I'm going to look at the inflation numbers today. But next week, I think inflation might actually come down slightly. So that might encourage the Fed to cut as well. So there will be two things that might encourage a cut from the Fed. So we shall see. Tomorrow's the first one. It's not here yet, so don't anticipate. But that's the S&P, the NASDAQ 100 right here. Same thing. It's now below that sideways channel, that highlighted area. It's almost down to this support line from way back here in November. So that's the next stop. And actually the downtrend is actually even below that, which is right about where the 3x ATR is too. So we really could come down below this support line, theoretically. And momentum is continuing to accelerate to the downside. You can see how these two lines are actually diverging. They're actually moving apart from each other, which means the downtrend is accelerating. Nothing is showing that we're getting any lighter colored bars of momentum. So momentum is actually accelerating now to the downside. So not what we want to see. Okay, Bitcoin, of course. Bitcoin actually held up pretty well today. So you can see right there, it made another higher high and another higher low. Bitcoin actually ended with a spinning top doji, but something like, if it was at the top of a trend, then it might be a reversal. But if it's in the middle of a trend, it's actually a continuation pattern. So it's in this symmetrical triangle that I talked about yesterday, has not broken out of it yet. It's got major resistance right here. It's just about at that. So Bitcoin actually held in pretty well. And you can see the momentum lines are crossing too right now. So that's actually encouraging. It's interesting because Bitcoin and the NASDAQ 100 have been highly correlated, but today they were not correlated. Today they went the opposite direction. And on the charts page for subscribers, there's a little Bitcoin section right here. So here's Bitcoin correlation with the triple leveraged NASDAQ 100. And you can see down here, it's still highly correlated because it's up here in the green. It's 0.81. If it was at 1, that means that every single move is exactly the same. But even being at 0.81 is highly correlated, but it's starting to come down a little bit. So it's becoming less correlated. So Bitcoin actually performed pretty well today. And then, of course, in here too is Bitcoin correlation with MicroStrategy. And you can see it is highly correlated too, 0.93, 93% correlated with MicroStrategy. So these two run basically in the same direction. MicroStrategy right now, it's just below its 50-day moving average, where Bitcoin is still a little bit more below it than that. So MicroStrategy looks like it still appears to be mirroring Bitcoin, but it looks actually to be a little bit stronger than Bitcoin right now. Not by much, but slightly. So that's MicroStrategy and Bitcoin side by side. You can find that right here in this little Bitcoin section. So if anybody's interested in understanding Bitcoin and Bitcoin halving, I did a Technical Tuesday on it way back a few months ago, but it's in the playlist. So if you go to the Technical Tuesday playlist, you should be able to find it over there. All right, I want to look at, because inflation's coming up next week. I want to look at, actually, before I do that, I'm going to look at the jobs because that's tomorrow. So let's look at the initial unemployment claims. Last time I looked at this, I said that we had one more week that had to be included because it was missing. This was the big jump in unemployment claims. And this last week, we had our huge drop in unemployment claims. So it's actually, pretty steady. It's a little bit higher than last month. So we might get a little tick up. Right now, the forecast is still for 4.0 for the unemployment rate. So I think we could possibly get up to 4.1, but we are not going to get the acceleration that would really worry the Fed quite a bit and would worry me because once it starts accelerating, it goes very quickly. But right now, it doesn't look like it's going to be all that bad. So the market might actually like what it sees tomorrow. We shall see. Then the 10-year yield ticked up, looks like a little bit today. The yield curve is starting to move back higher. So that's actually a good thing. So we'll keep an eye on that. But that's tomorrow. Let's look at CPI. This is for next week. CPI, I'm going to look at these as a bar chart this time. So here's the bar chart. CPI, 12-month base effect is the shaded area. So when we add another one, this whole thing will move to the right. So you can see when we added this one, this big one right here is the one that dropped off. But we had a bigger one that got added on, and commodities went much higher last month. So the inflation rate went from 2.9 to 3. Went from 2.7 to 2.9 to 3. So 3 months in a row, increasing CPI. I think this month is potentially could come back down to 2.9, or at a minimum, it's just going to be stable at 3. But I think we could come back to 2.9 next week. And let me show you why I think that. If we look at commodities right here, so that shaded area is what will be reported on next week. This is for February. And you can see all the commodities. DBC is all of these things over here. It came down. DBA is all of these, mostly food products. It came down significantly. CRB, which are these over here, this is the Commodity Resource Bureau, 19 major commodities. It came down. Copper went up. Copper went up quite a bit. Gasoline went up as well, but oil went down. So even though they're not all going lower, enough of those are going lower that I think it will help CPI next week. That and the base effect that I showed you before, where there is another large one right here that will drop off, and then a large one here. So this will be the March report. This will be the April report. And then look what happens. We've got a really small one there, and we have a negative one there. So when we go to get into this May or June timeframe, then CPI is going to appear to be reversing and going back higher again, and could potentially even go above 3.0. So the summertime is going to be very volatile. We could have this continuation. We will get a bounce at some point, but overall, I don't think it's going to make a higher high. I think it will make a lower high the next time. And I think through the summertime, the market will continue to go lower until we get into October timeframe. Yeah, right around in the fourth quarter, just before the fourth quarter, into the fourth quarter. That's when the market usually takes off. So we shall see. But right now, things don't look that great. If we look at PPI, on the other hand, you can see PPI had a huge tick up in the last report. So we'll see what happens on the next one. And then PCE on a bar chart actually came down. So PCE, which is the one that the Fed likes to look at, actually came down lower in the last report. So we'll see. It could continue to start to go lower again in the next one, which is actually, this is actually the one that the Fed looks at. So that might be good for them to see that. All right, let's get down to the daily routine and take a look at the trend analysis. Once again, the S&P, we looked at this yesterday, and I said that it had gone, the medium term went below zero, just like it did back here in 2022. 2022 was a long cyclical bear market until October, right there, when it hit the 200-day. We look amazingly identical right now. So this was the first red bar right there, broke the 21 moving average and started going towards the 50, and the medium term went below zero. Here's where we are now. In this case, it's the second red bar, but broke the 21 and is heading toward the 50. And everything right now looks very, very similar. Notice the money flow, quarterly money flow is the darker one right there, sitting right on the zero line, which is exactly what happened back in 22. So all of these things are starting to line up. I've been saying this for a couple of months now. So this should not be a surprise to anybody at this point. Let's look at Keltner. This is the moving average of the, that's not, oh yeah, that's Keltner. I'm sorry. Keltner channels are the extreme. So we are in the 3X area, but just barely. So there's still room to go, still room to move down. So this is certainly not over yet. It was the other one I wanted to look at. McClellan oscillators, that's the other one. This is the moving average of the advanced decline line. You can see here, continuing to go lower. It's now below the 25, negative 25, which is confirmation that we're in a bear market now. And you can certainly see there are lots of red bars down here. A couple of blue ones were bounced just for one day, but turned back red again pretty quickly. Bullish percent index is also heading lower. It's getting back down to the lows that it experienced back here at this low, but we're under that right now. And the other things that I'm looking at, which I'll show you in a second, actually this one, when this happened back here, some of the other ones were indicating a bottom. This is not yet indicating a bottom. So this could continue lower. So let me show you that. I showed this the other night with the bottom finder. We'll look down here at the 50, 200-day moving average analysis. And you can see we're now below that key 5850. We're sitting right on the 200-day moving average. Sometimes things bounce right there. If it doesn't, then we are in for a lot more selling. Probably all way down here, 5150 is where we could be heading to. Put call ratio, this is another one that if it's going up, then that means there are more puts being bought. That means the market's getting more bearish. When it's extremely bullish, that's usually where tops happen. And when it's extremely bearish, way up here, above that green line, that's where bottoms happen. So right here, you can see the bottom. Right here is this bottom. We are not there yet. We have quite a ways to go. So there could be a lot more to go. Also, the 20-day moving average is sitting at 37%. Really, we need to get down below 20% for a bottom. The 50-day right now is at 42%. We need to get down to 20% for a bottom. And then the 200-day, which moves a lot more slowly, especially in an overall bull market. So if this one starts to spend a lot of time below 50, that is an extended bear market. Right now, it's spent a lot of time above 50. So the 200-day is actually below 50 slightly, 49.6 on the S&P. And if we look at these on the NASDAQ 100, which has 100 stocks, so it's pretty easy to identify. 32 stocks in this case are above their 20-day. 44 stocks are above their 50-day. And 53 out of 100 are above the 200-day. So you can see there's a lot more to go. So sorry to be the bearer of bad news, but there could be a lot more selling left in this market before we finally get a bottom somewhere. And I'll let you know when I think I'm seeing something like that. Let's look at the high-low chart for a second on the NASDAQ. So clearly you can see this is the new highs minus the new lows. So there are clearly a lot more new lows right now. In fact, it actually reached a peak right here and then pulled back quite a bit. So some of those new lows came back up today. Same thing down here. This is new highs and new lows. And down here are the NASDAQ 100, new highs and new lows. So you can see fewer highs, lower greens, more reds, except for today, actually. I think this actually is yesterday because I don't think it hasn't created today's yet. But at any rate, a lot more below the line down here than there is above the line. It went back up a little bit through this sideways period, but now decidedly below the line. We'll look at the Hindenburg omen here real quick, just for fun. There's the Hindenburg. It's actually not really showing anything. It showed something back here. This is when three things happen at the same time. The NASDAQ 100 is above the 50-day moving average. NASDAQ new highs and new lows greater than 2.5%. So that means they both happen at the same time. We get new highs and we get new lows at the same time. Right now we've got lots of new lows, but not new highs above 2.5%. And then the third one is the McClellan oscillator, which I just showed you, is below zero, which it certainly is right here. This is the McClellan oscillator. It is below zero right there. So 2 out of the 3, actually this is showing, oh yeah, it's not above the 50-day moving average anymore. So only 1 out of the 3. So if we get the first level is 1 out of the 3, the second level is 2 out of the 3, and if we get one up here, then it's 3 out of the 3. And what you want to look for is when they're grouped together, a lot of these together in the third level, like we had back here, that usually indicates that within 30 to 60 days, there will be a sell-off. And that's pretty much what's happened. 30 to 60 days later. Now, if we start getting clear space, that's usually the recovery. So that, interestingly, let me see where we are. So right there, no, we don't have clear space yet. So that's another indicator that a bottom could be near. You can see there's clear space right in here and right in here, right through this bottom. There's some clear space right here, right at this bottom, but we don't have that yet. That means none of the three are triggering, but we don't have that yet. So we'll continue to watch, but all of the indicators that I look at are implying to me that we still have a long way to go before we actually hit a bottom. Let me go to the portfolios real quick because I meant to touch on this yesterday and I didn't. I want to show the weekly is now decidedly, this will actually turn to cash tomorrow. I have absolutely no doubt. It would take a miracle for it to get back above the 21 day. There could be a relief rally based on the jobs number. We'll see. That could push it back higher, but I seriously doubt that it will get back above the 21. So if you look at the chart, you can see right there how far down it is. Even this one back here, this one here sold off in the first day of the week, and then the whole week came all the way back. This one here is the opposite. This one is actually selling off all week. So I am pretty confident that will not get back above the 21, and that means that this will turn to cash. Now, this doesn't mean you have to wait for this signal to go to cash. Anybody can do it at any time, and everyone can look at these charts anytime they want to. I went to a short position here, and I showed the date, which is February 24th. This is on the short term, so this means it may not last that long. But if we look at the daily chart, you can see right here, February 24th, this day right here, is when it went to the short. The day before, it went below the 21, closed below the 21. So the very next day at the open, went with the whatever inverse ETF you choose to go with. So you can use the VTI for the signals. Does not mean you have to trade or should trade the VTI. VTI is total market index, shows you all of these things, Dow, NASDAQ, S&P, Russell, all of those in one ETF. Does not mean to trade the VTI. This is just for signals. That's all. And then you can choose any of these ETFs that you would like to trade. So if you want the 1X S&P, NASDAQ, or Russell 2000, they're right there. Or you can go all the way to the highly leveraged. And if we were in the highly leveraged inverse ETF as of the 24th, right there, then 24th was right there. So you can see it went above the 21 right there, and the next day at the open, basically $28. Got in, and it's still in. So the signal is still on for this negative one. Now let's count 1, 2, 3, 4, 5, 6, 7, 8, 9. So 8. Remember, 8 to 10 bars is what John Carter likes to see, or hitting the upper channel of the ATR, which it's not really quite there yet. It actually could go a little higher before it hits that. So we'll see. We'll see what happens tomorrow. But I just wanted to point that out, that this one is short. It now is, since the 24th, is up 5%. And cumulatively, since the start of this long-term trend on November 3rd, it is up 42%. So you actually would have done better trading in and out over this period, but you would have to pay more taxes as a result. Whereas on this one, you would not have as many trades. It's only one trade in nearly a year and a half. And you'd be able to take long-term capital gains. This will most likely go to cash tomorrow. So that will be the end of this trend that started back in November of 23. So this is for subscribers. You can come here anytime you want and take a look at these. You can read all this, explains how it works, and some additional charts down here if you wanted to look at weeklies or dailies of some of the leveraged ETFs down there. All right. I have no symbols to take a look at. So if anybody would like me to look at any of your symbols, please put them in the chat box. Nobody did that last night. There were not too many people that commented. So I don't know if maybe because the market's been going down so much, everybody is getting discouraged and saying, I'm just not going to look at things anymore. That's often what happens, which is fine. It's okay. We'll be here when it turns. I'll be telling you when it's about to turn. So please like and share, and we will talk to you again tomorrow. Thanks, everyone.